This crazy weather we have here today in Miami, you would almost think we were in California. One minute it was beautiful, next minute it was pouring rain, everything is drenched. And you know how the weather just changes so fast like that sometimes? It's just kind of unbelievable. Well, it's funny because this is a great analogy of just how fast the housing market has changed. Because let's face it, guys, for 2 straight years, things looked like they were going just nowhere but up. It was seemingly unstoppable. Well, obviously all of that is coming to a halt now, and we have a lot of major changes to discuss that are happening right now in the housing market. The first real big point that I want to mention here, and we're going to go over some of the recent Redfin data ending this week, and this is something I find truly fascinating, guys. The median home sale price from 1 year ago right now is only up 0.8%, so less than 1%, up to 351,000. So you know how everybody uses this argument, well, we don't have anything to worry about because home prices are still up year over year? Well, I can almost guarantee you by the time February hits, maybe March at the latest, that number will finally turn negative. We're going to see home prices down year over year according to Redfin. Okay, we already see it dropping month to month, but the year over year numbers have not really kicked in yet, and this is basically the last month that we're probably going to see a positive year over year price increase. This should come as great news to anybody who's been in the market waiting to buy a home, because prices are finally returning to normal. And really in line with that point is the fact that median home asking prices are only up 3.9% from a year ago, which means that more home sellers are starting to come to terms with reality on what the price of their home should be. So that means that if you are going to be a buyer at some point in 2023, you're going to be far less likely to be looking at listings that are overpriced, because people who are going to be listing in this environment, chances are they probably actually want to sell and are not going to be playing too many games with the price, which is great news. Another real big major change is that pending home sales were down 31.7% year over year, and that is the lowest level on record, and that's also the 12th straight period of pending home sale declines. And that is just astonishing, guys. When you see just how fast everything is changing right now, it should be glaringly obvious that the housing market crash has started. Once again, we're not going to go over too much in this video how much it's crashing and where, because that will vary depending on where you live. But these high-level market signals are the indicators that we need to look at that are showing that everything is going to be heading down. And you know, even if your market is still not one of those markets, it will catch up eventually. You're just going to have more patience, because some markets are more resilient than others. And here are the cities where the pending home sales are falling the most, which really doesn't come as a big surprise. You have Las Vegas down almost 62%, guys. Jacksonville down almost 58%. Phoenix is down almost 57%. Austin, Texas down 53%. Nashville, Tennessee down by 50%. So the home sales in these areas are completely falling off a cliff. Now here's a real fascinating dynamic that we're going to have to keep an eye on throughout the rest of the year that is really going to determine the shape of things to come with the 2023 housing market. And that is the new listings that are coming each month, as well as the total active inventory on the market. Because here's an interesting thing. The new listings of homes for sale are actually down almost 22% year over year right now. So that means 1 year ago today, there were 22% more new listings coming to the market, obviously because the market was still red hot 1 year ago. But now that all that has changed, there are less listings coming to the market than before. Even though we have less listings coming to the market than before, that's still not enough to bring down inventory, because check this out. Active listings, which is the total number of listings available for sale on the US housing market, are up 20.7%, guys. So even though the amount of people that are listing their homes has been falling, the actual active inventory is skyrocketing even faster. Why is that? Let's talk about that for a second. Because common sense would tell you that, well, if we're not getting a bunch of new people listing their homes for sale, then inventory should be going down, right? Well, except we forgot to mention the fact that no one's buying houses right now because people can't afford them. In a lot of cases also are not even willing to pay these prices that we have along with the interest rates. So that's the funny thing. Even though less people are listing, we still have more listings on the market, 20% more than 1 year ago. And I find that extremely fascinating. And this is just the beginning. I feel like that trend is going to continue well throughout 2023, and that's why I think if you are patient, that this is going to be an excellent year for home buyers. Not saying that you're going to get the best price ever, but I'm saying that you are going to have far more options than you did a year ago, and that is going to be good for you when it comes to picking the right house, and it's also going to be giving you a lot more negotiation power in the deal that you didn't have a year ago, and most likely you're going to be able to get the house for less than what they're asking for. But don't count on getting the bargain basement prices this year, guys, because housing crashes take years to play out, and really the best deals probably won't come until well into 2024 or even 2025. But like we've talked about many times, people will always be buying and selling regardless of what's happening in the market. And so if that's you, this is still good news for you. And to be honest, guys, I think a lot of home sellers are going to be happy about this too, especially home sellers that have been wanting to move or, just had plans to move, but then they didn't because the rates were too high and, the housing inventory was too tight. Well, this is your chance too now, guys. I mean, if you're a home seller, maybe you'll be able to sell your house for the fair price and go ahead and pick up another one for a fair price later in the year. So this can benefit sellers too. You guys ever seen a silver Tesla like that? That's a first, for me anyways. And to the point we were just talking about with inventory, the month supply of homes for sale in the U.S. housing market is also going up. That is up to 3.8 months now, and it is said that a 6-month supply is basically a balanced market. So we are almost there, guys. That's basically just 2 months supply away from being a balanced market. And if these trends continue that we're seeing right now, with the amount of listings lingering on the market and new people listing, especially as the spring season comes, we can easily get into a more balanced market by spring this year. Because all of the signs that we're talking about here are pointing to everything slowing down. You have 27% of the homes that went under contract had an accepted offer within the first 2 weeks, and that's down from 34% a year earlier. And now homes are starting to sit on the market for the longest period of time since the pandemic began and all the lockdowns began back in March of 2020. Now the median days on the market for the average home is 44 days on the market, okay? So that was the same number of days on the market that we saw back in March of 2020. So these are all signs that things are finally starting to normalize. And another statistic that is the same as March 2020 is the amount of homes that sell over their list price, which is not really that common in most areas, but it still happens, okay? And 22% of homes sold above their final list price, which is down 40% from a year ago. So that just goes to show you that far fewer people are getting into bidding wars and paying over asking price for homes. So that is great news as well. And really you can back that up with the amount of people who are not paying full price on a home anymore either, because the average sale to list price ratio, which measures how close homes are selling to their final asking prices, fell to 97.9% from 100.1% a year ago. So that's also the lowest level since March of 2020. So you guys see the common theme here is that everything is dropping back to pre-pandemic levels so far, or at least the start of the pandemic. And I believe as we move through 2023, you're going to see many things fall back to pre-pandemic levels when it comes to home prices in certain areas, when it comes to the normalcy for how long it takes for a home to sell, when we're looking at home inventory. In fact, when you look at our inventory, we are almost at pre-pandemic levels, guys. We're almost there. And then I know a lot of people are going to say, well, that's not a housing crash, Michael. That's just everything returning back to normal. We are going to have a period of time when everything looks to be normal, right? But here's what everybody needs to remember. The US government, the Fed, everybody who's in charge of our entire economy won't even say the word recession right now. And a lot of you probably know that we have been in a recession for some time. At least it definitely seems like it when you look at the overall state of affairs. And here's the thing. Whenever they say that it actually is a recession, that's when you know it's officially worse than it is right now. So what we're going to have is a short period in time where everything looks like it's back to normal, right? But then what's going to happen is everything's going to continue to fall further from that point, because then the recession will become official, and that's when everything will keep taking a turn for the worse. But it all depends on your perspective, guys. I mean, taking a turn for the worse for who? For people who, are borrowed to the hilt on their home equity? Yeah, it's going to be turn for the worse for you. Home buyers that have been patient? Absolutely not. This is going to be good news. So it all depends on who you are and how you look at things to really say if this is good or bad news. And I would say it's going to be bad news for about 30% of Americans. And where did I come up with 30%? Well, I'm coming up with this from this most recent report from Credit Karma, where they came out with a survey saying that 30% of Americans are going to be relying on their income tax return just to make ends meet and to be able to pay their bills this year. And that is quite a bit, guys. I mean, that's a third of everyone who's relying on this. And when you break it down generationally, the percentage of the younger generations relying on this is even higher. Gen Zers and millennials, 40 and 46% of people in that age group are relying on this year's tax return to save the day when it comes to their financials, which is just insane if you ask me. I mean, as an entrepreneur, I don't get a tax refund, like when you work for yourself, you pay in taxes most of the time unless you overpaid, which is never the case for me. So, you have a lot of people out there that don't even get tax refunds like myself, and to just hear that some people just are banking on this being like their biggest financial windfall for the entire year is kind of insane. And here's the real kicker, guys. A lot of people who are getting a tax refund this year, it's going to be smaller than it was last year, because a lot of the tax incentives and the programs that were in place have expired. And so people who think they're going to get a huge refund, there's probably not going to be the case. Because check this out. In 2021, the average refund was $2,791, but in 2022, it was up to $3,176. So it was about a $400 difference. So people got more money in 2022, but now this year it's going to go back down. So anybody who thought that they were going to get more money than last year, probably not. Now, I don't know if you guys saw this or not, but Treasury Secretary Janet Yellen, she came out this week and said that by Thursday, we are going to hit the national debt ceiling, and now Congress needs to make an emergency act to make sure that the U.S. doesn't default on our debt obligations. Pretty crazy, huh? Sounds like it's not just people who are going to be in trouble, but also the U.S. government. And what they usually always do is they do an emergency spending bill. They do something in order to make sure that the U.S. doesn't default on their debt, because historically we never have. So the odds of it happening this time are extremely low. But obviously there's a divide politically. The Democrats want to make sure we raise the debt ceiling, and the Republicans are trying to put their foot down and say, no, we don't want to raise the debt ceiling. Let's cut the spending in different areas where we can, and we'll deal with it from there. But obviously, you have two parties that want different things. It's going to be interesting to see where this ends up real soon. But it just comes at like what point, guys? We keep raising the debt ceiling, right? Every single year, we keep saying, oh, we're just going to, have this bigger and bigger debt bubble to just keep ballooning here. And the problem with this is that this is never going to get paid off. That's basically the system that they run on here, is let's just keep inflating the debt bubble to oblivion, And the problem with that is it just puts you and me and your future children and grandchildren and their children on the hook to pay this off, when in reality, we're never really able to pay it off. So in the end, what this does is it just makes life more expensive for us. It makes our taxes higher, and it makes us work harder for less money, which to me is just a crime, you know? Now, one thing that's interesting when it comes to flood insurance is a lot of people in California are getting a big wake-up call, and they're realizing that they don't have flood insurance and they have all this property damage over there because they thought they would never be able to get flooded out. And on some level, that's not too much of an unreasonable thought, considering how dry it typically is over there. And these guys are getting, you know, rain that probably is like on a record amount scale. You know, it's just so much rain so quickly, which is almost unprecedented for California. So, you know, if you've been there for a long time, you've never probably really seen a rainstorm like this. And it's not really unreasonable to expect that your property won't get flooded. But when you see stuff like this happening, it's a good reminder that flooding can happen anywhere, guys, even where you least expect it. Even it happened with Hurricane Ian. We saw that. You know, you have a lot of people who live inland in Florida, especially over by the Orlando area, got totally flooded out during that hurricane, that thought that they couldn't flood because they're inland, they're not by the coast, we don't have to worry about the storm surge, blah, blah, blah. And turns out, wasn't really the case. I'm not telling everybody that you should go out and get flood insurance on your property, but you should definitely be weighing the risks of what could potentially happen if you don't have it, because I'm sure a lot of people that just went through these crazy flood scenarios over there are really wishing they probably had it right about now. It's just sad that it comes down to that. And you're kind of like gambling too, right? You can pay for 30 years for flood insurance and never have a claim, and all that money is thrown down the drain, right? But then you have this one-off event that happens every 100 years or whatever, and that's when you need it. Now, we recently saw Wells Fargo say that they're going to be done when it comes to the mortgage lending business, which is fascinating because they were literally the largest mortgage originator in the US for a long time. And for them to come out and say that we're done issuing mortgages is a pretty big surprise for a lot of people. But it's not just Wells Fargo who's doing this. You have a lot of other smaller lenders who are following suit because they're recognizing the trend that the future of mortgage lending right now isn't looking too hot. There was another small lender called North American Savings Bank, and they're out of the Midwest, and they recently announced that they're going to be shutting down their mortgage lending division as well. And with that does come layoffs, because one of the main reasons to do this is to shed payroll, they said. So what does this all come down to? Cost cutting, because the mortgage origination business is basically in the gutter right now. And here's what one of the big dogs over there said. He said, "This was a difficult decision, but we believe that it's in the best interest of the company, given the current challenging market conditions highlighted by rapid interest rate increases in 2022, low or shrinking housing inventory, and double-digit median home price increases." So the funny thing about this is these guys are giving up, right? But in the near future, probably in like a year from now, it's going to be really good to get back into the mortgage lending business, most likely, as buyer demand starts to come back when prices have come down probably 15-20% by then, and you have a lot more inventory on the market. The demand for mortgages is going to be huge. But if they don't come back, then what's going to happen is what we've discussed here before on the channel, is you have a situation where it's very hard to obtain credit. You know, you have people that want credit, but there's only so many lenders willing to dish it out, and the lending standards that they're going to be using to qualify people are going to be tighter because it's riskier, right? It's very risky for a mortgage lender to hand out a loan in an economic downturn, because by then it'll already officially be the recession, and home prices would be seen falling month over month basically, which they already are. And what kind of lender is going to want to come out and give you a loan on a property under those conditions, right? It's very risky for them because, you know, the home could be continuing losing value, and they're not sure if you're going to be able to make your payment because people are being laid off, people are losing jobs, things like that. So it's interesting to see so many mortgage lenders give up right now when pretty soon, probably like I said, maybe a year from now, is when you're going to see that most people want to get a mortgage, at least the ones that can still afford it, the ones that still have a job to get a mortgage to begin with. Interesting times to come, guys. But they are looking out for their bottom line right now, because even though rates are going down, you have new loan activity sinking down to the lowest levels that we've seen since 2014. That's 9 years, guys, that we haven't seen new mortgage purchase applications go this low. You know, being a mortgage originator right now is a dying business. It's just like being a real estate agent right now. It's very difficult because you have a record amount of real estate agents competing for less deals than ever. So that is like the kiss of death when it comes to being an agent, and literally the amount of transactions that agents are doing has fallen half of what it was a year ago. So all these people are not going to be able to stay in business. They're going to be quitting, you know? It's just going to be a matter of time because, for example, my realtor fees here in Miami, a lot of people think you just have to pay the National Association of Realtor dues. It doesn't just end there, because if you want access to your local MLS, you have all sets of other fees to pay, plus your state fees. So last year, like, my dues are always due in June, okay? I think last year I paid probably like $780, something like that, just to keep my MLS status, just to keep my realtor status and have access to the MLS, different things like that. And if you're a real estate agent and you're actively selling and making money, it's no big deal to pay that, you know, it's affordable, you can pay it, you know, it's a business expense, cost of doing business. But if you're not making any money and the amount of transactions that you're doing is cut in half, and you're facing inflation and higher bills just like everybody else, the chances of so many agents continuing to stick with the business this year is pretty low. And that's something we're going to take a look at in probably a couple months from now to see if the amount of real estate agents is starting to go down, because my guess is it's probably going to continue to go down throughout the rest of the year. All the people who thought we're going to get into this is going to be easy money during the height of things, those guys are going to get wiped out. We saw it during the last housing crash. We're going to see it again this time. I remember seeing records amounts of agents quitting, even in my local office when I first started. So that's coming, guys, probably this year. So lots of interesting stuff to cover in real estate in 2023. If you guys enjoyed this video, make sure you hit the bell notification down below. YouTube will alert you every time I post a new video. If you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.